Chris Cutler, the founder of Manager Analysis Services, will now talk about investment fees.
Thank you, David. I think you handled some very tricky topics there. And I certainly appreciate the comments you made about risks and things that have been problems for investors in the past. I've certainly seen many of that in the last 16 years in business, helping people through very successful and sometimes trying circumstances. What I have to say is actually a lot brighter and optimistic because it's a real opportunity for Catholic foundations and dioceses to, on the fee topic. The topic I have is fees. Are you getting full value from your investment service providers? And so fees are actually really important. When we talk about fees, we're not trying to squeeze managers or minimize fees, but it is important to make sure that the fees that you pay for investment managers and service providers are fair and appropriate for you and for them. And there are many considerations around that topic. There are some practices in the asset management business that probably would not, be things we would appreciate. So I would like to highlight what some of those are, just for you to be aware of them. One of them is that there's the stated fees that the asset manager shows, but sometimes there are undisclosed fees, hidden fees. There are layering of fees, etc. It's not necessarily the case that all those fees that are immediately hidden from the investor are inappropriate. They're actually fees for services that are important, but sometimes they are not appropriate, or they're much higher than you would expect. And I think, from our perspective, when we advise any kind of investor on their investment, we want investors to understand the full scope of everything they're paying for and to make sure that they are comfortable that that is appropriate for what they're getting. So how important are fees? Okay, so, fees sound like they're just a little nuisance thing that may need to get paid now and then, but they can actually be really important to your destiny. Fees that are, it is not uncommon for us to see fees that are where people are paying 0.5% to 1% per annum more than they should. And that sounds like, 1% in a year isn't much. Over 10 years, that's 10% of the financial aspect of your mission that's been compromised. So and then over 20 years, that's obviously even worse. So we want to really understand, and we encourage you to understand what you're paying in terms of fees. It's a real opportunity now, and here's the reason. Institutional asset management fees have fallen by half in the last 5 years. That means that if you're constantly refreshing what you should be paying in terms of your asset management fees, you're right on this. You understand where you are, and that is fantastic. If you haven't been refreshing what your fees are with your asset managers, you're probably paying far more than you probably should. And there are reasons why fees have declined. There has to do with the market structure, but it also, as asset managers get bigger, their cost base can basically get amortized over over a wider base. So in a world of competition, it doesn't mean that the asset managers are necessarily making less or that they deserve less, but those fees savings should be passed on to, especially in your case, to charitable clients. So it's something we strongly encourage you to look at. Certainly there are analogies that you see readily in the retail level where mutual fund fees have fallen dramatically. Brokerage fees for trading stocks at some places are now zero. And another thing we have been seeing more on the institutional side is that asset managers are charging new fee structures to institutional clients. And what those structures tend to be as following: that the management fee is super low, close to zero. And if they beat their benchmark, for example, if their performance as a stock manager is better than the S&P 500 index, if that's what their benchmark is, then they share that excess profit between themselves and you. And so what that does is it protects you from a regret that you hired an active manager when you could have invested in an index manager, because an active manager has higher fees. So if they don't do well, you're not paying more than, say, you would to an index manager. And so that's actually a structure we find very interesting. However, I would caveat that with your investment strategies are most likely differentiated from most others because you will have a focus on mission-driven investing. There are investments that others will make that Catholic institutions will not make. That requires extra work and diligence. And we want you to be comfortable that what you're investing in is consistent with your mission. There's work that's involved with that, certainly analyzing companies and making sure first that there are certain companies that you definitely don't want ever in your portfolio. And then there are some where 98, 99% of their business is completely fine, that there's a 1 or 2% that's potentially a problem, and that you understand what those considerations are, and you either decide that works or doesn't work. That becomes very specific in terms of how your dialogue works with individual asset managers running your portfolio, and of course that causes higher fees. So there's some give and take there. Now, taking a deeper dive into the topic of what the things are you should look for in terms of your fees. How are fees reported to you? There are fees that are stated on your your investor statements on a regular basis, but there are also fees that tend to be buried. For example, in alternative investment strategies for hedge funds and private equity, also for real estate, there are what are called incentive fees. And those incentive fees are often not reported under your management fee item. So you'll get a full disclosure of your management fees, but it could be that your incentive fees are greater than your management fees. And those incentive fees should be understood about whether they're appropriate and how much they are. There are other things that may also not be reported. So, for example, your management fee may be reported. But what about other expenses, or custody, audit fees, administration fees? There can be even fees related to marketing services. There could be fees related to trading expenses and things like that are not reported to you. And it's important to understand what those fees are. It's not necessarily the case that those are all fees that are snuck in there because they're bad, but certainly sneaking in of fees and expenses that you're not aware of is a problem. And we are strong advocates that you should have full transparency about all fees and all expenses. Okay. There are other areas that you can incur expenses that you should be aware of. There are, whenever you replace an asset manager, you're generally firing one and hiring another. Well, an important question is, how do the actual securities move from one asset manager to another? Does the first manager sell all their stocks and bonds, and the next one, the new manager buys them all again? If so, that's a very wasteful strategy. And it's an area that many investors take for granted, frankly. But it can cost you, anywhere from 0.5% to 3 to 5% of your portfolio in terms of slippage costs from doing that. Some of those slippage costs are simply that once managers sold all the securities, the market went up and you were not in it because you're in cash. And then the other one buys into the stock market at a higher price. That's an area where you want to be really careful, and we encourage you to get help if you're not familiar with doing that and what's called transition management. Another area that arises with that is that the old asset manager, because they're getting fired, if they don't have good ethical standards, they will tend to direct the trades to their quote-unquote friends on Wall Street, who will then charge you wider what's called bid-offer spreads or commissions than you might get by trying to get best execution somewhere else. And so those are the considerations around fees. There's a topic I'm not going to discuss in great detail, but I'll just mention it, which is that sometimes there's a relationship between donors to charities and the fees to whom you pay. So, for example, if the owner of an asset manager is a donor to a diocese or a foundation or a parish, sometimes there's some areas there where you want to be very thoughtful about what that actual dynamic is. But if you have any matters that relate to that kind of, I guess they call it a correlation between donations and fees you're paying, it's something we can discuss with you further online as an area that we recommend calls for diligence. It's not so simple as the question is how low can I get my fees? And so there are always bigger considerations at stake there. So, I guess in terms of, it's helpful to share some stories about fee reductions we've seen over time. We've seen clients that thought their fees were, say, 0.3% per year, but the actual underlying was as high as 3 to 5% a year. The more common case we see is where people are just over allocated to high expense managers, and they can renegotiate the fees with their existing managers is often what we see. Sometimes the situation is untenable and the managers need to get replaced, but it tends to work both ways. Looking at your fees is not necessarily an exercise in replacing all your managers. Often it's simply a matter of catching up to what's already happened in the marketplace and what's already considered fair to both investors and managers. And it's important for you to make sure that you're getting the benefit of those positive developments that have occurred in the last 5 years. And so that's what I would wrap up with in terms of my comments. The real question is, are you getting what you're paying for? It's not just fees, it's also what the actual experience is. Sometimes it's better to pay more for better performance. Sometimes it's better to pay more to have the appropriate, well, in this case, always important to make sure you're getting mission-based investing. You don't want to end up with a situation where you're investing in something that's absolutely detrimental to your mission. There have been recent stories about what's called ESG investing, where the investors thought they were gaining something that was much more aligned with their missions, and it turned out they were not. So it's important to take a close look at what the methodologies are of these managers, not just take their word for it that they conduct mission investing, and actually test by looking at the underlying portfolio versus your own values to make sure you're getting, what you wanted. So there's one last comment I have about what's going on in the marketplace, which is that managers have their listed rates, but we're in the business of manager analysis. It's our very name. We've looked at over 2,000 managers. Managers have their listed rates. Sometimes their actual rates are the same as the listed rates, but often, especially given what's happened with fee compression, they can be more flexible in private discussions. So it's an area where you might want to take a look very closely at what you're doing with regard to fees. Those are my comments about fees. I think it's a true opportunity for many investors to look at what their fee relationships are, because it can enhance your ability to give to what your mission is in the future. So I will now pass it on to David Skelding.
You've just heard from Chris Cutler, founder and president of Manager Analysis Services, manageranalysis.com.